move. Let's bring in the former Vice Chair of the Federal Reserve, Lael Brainard. Lael, wait, is that a correct move? And he was very, very clear, having used the word 22 times. What did you make of that?
Well, you're exactly right. It was notable how much we heard about how they are in a good place, how they can wait and see, how uncertainty has risen, and how they can afford to be patient. And you saw in the statement, they said the risks of both higher inflation and higher unemployment have risen, and that, of course, is associated with tariffs. So they are waiting to see whether they have to be more worried about higher inflation from the tariffs or about higher unemployment for the tariffs. And that's why waiting and seeing is a good strategy. Now, of course, he also said that once they get more confident, they can move very decisively.
And that confidence, he said, would come from the data. Here's my issue and my question and my concern, and that is, we know data lags. It takes several months sometimes for it to show up. But when you're waiting, and you're waiting to see the headlights come around, and you don't realize the truck might be speeding, and you take your move, sometimes it's too late to get off the track, and you're smacked in the face by the headlights of the train.
That's exactly right. So here is the dilemma. You can wait and be more confident about the data, or you can make a move, and the risk is that you jump the wrong way. And so that, I think, is where the Federal Reserve is today. What we heard yesterday is that they feel like they are in a pretty good place. And if you look at the hard data that has come in so far, the first quarter was actually a pretty good quarter, and the chair referenced that in his press conference. We learned today something about what those tariff deals might look like. And one of the biggest things is uncertainty about how the tariffs are going to play out. If we learn something today, it's the best deal that any country can possibly expect is going to still have a 10% baseline tariff. That's a 5 times higher tariff than before the president took office. That is a big increase in prices for American consumers. And of course, that wouldn't cover China, where tariffs are still 145%, and where you could see much larger price increases. And that's why the Fed is really on the fence, waiting to see how much inflation, how much slowing.
Well, President Trump has been very clear in the last 24 hours saying he's not lifting that 145% tariff on China. So that brings me to the Fed funds futures number. At the top of the show, we had Rick Reeder of BlackRock Fixed Income, and I asked him, what should the Fed funds rate be? It's at 4.25% to 4.5% right now. He said, and he actually supported the Fed waiting. He thinks the economy is strong enough at the moment, but he said, you know, it probably should be around 3.5%. Where do you think it should be at the moment?
So what normally we would be looking at is what's the underlying real rate of interest, and where are we on the potential inflation rate. And so where you get a 3.5% is if you think the underlying real rate of return should be about 1% on top of where we are right now on inflation, let's call it 2.5%, that's where you end up. But if you are concerned that inflation is going to jump up because of these tariffs, and as you said, the president has not really shown any leg yet on the 145% tariffs on China, that means huge increases in things like toys and dolls and the kinds of things that Americans buy every day, furniture, clothing, shoes. So the Fed is, I think, quite concerned that we've seen high inflation. They need it to come back down. It's still above 2%. And if we see those very high China tariffs staying in place, inflation will be going in the wrong direction, which will make it difficult for them to lower rates. And that is why they are waiting till that uncertainty gets resolved.
Boy, 2 mandates that require 2 totally different moves. One thing we know is that a whole bunch of countries this week cut their rates, and that includes the Bank of England, which cut by 25 basis points. China cut by 10 basis points, followed by Poland, Czech Republic, Pakistan. They've got a bad situation with India right now. They cut by 100 basis points. So it doesn't look like, at least if I've read the Fed's tea leaves, that he's going to do the same. That said, does that mean that you see a possible recession by the second quarter? Because we already got the negative GDP print, tiny, and there were some dislocations within that, could be explained away for first quarter. But do you believe that we might see a quick but real retrenchment here, and that would equal a recession?
You know, I really don't expect to see another negative quarter in the second quarter. It could happen, but don't forget that a lot of what was going on in the first quarter was that companies were front-loading, right? And so they were importing and stocking up on inventories. And we just don't know how much those inventories will be drawn down in the second quarter, but underlying consumers were still buying. And we could see that continuing to support the economy in the second quarter. Now, later in the year, I think that's where the risk comes, because businesses have been sitting on the sidelines because of the tariff uncertainty. So less investment, less hiring, being cautious. And, you know, we heard in the Beige Book, even some companies doing some layoffs. We're not seeing it in the labor market yet. But if we do see that real slowdown, it could come later in the year, third quarter, fourth quarter.
All right, we'll see if it's consecutive or not. Lael, great to have you.